Hello everyone and good evening. We are live from Chicago. Today is Thursday, April 10th. I'm Charles Brown, Portfolio Manager with CB3 Financial. We are so glad you are with us. What an amazing time in the market. We're going to talk about that tonight. If you're so inclined, I would suggest you get the popcorn going and an extra cup of coffee. I'm going to be with you for a little while here as we carefully walk through everything that's happening in this tariff turmoil. Now, my ace graphic designer, Heidi Steiner, comes up with great thumbnails, but this I think is the best one she's ever done. I had a couple viewers say, man, this is intense. You're promoting this on Facebook and this is the thumb you're using and you got Trump there scowling, but the intent was that I'm relaxed and presenting this to you tonight. So I hope that's what it conveys as. If you are new to the show, please subscribe to us. And the reason for that is when I go live on a special event like I did Monday night, you'll get that notice, not just on Thursdays, but also on Monday nights. From time to time when crazy things are happening, and click the little bell so you get notified. Follow me on Facebook, X, and LinkedIn for my daily tweeting, and of course, the podcast series, which is working on a year now, almost at the 1 year point. Every Monday I'll have, or if it's a holiday, it'll be Tuesday, but roughly once a week, I'm going to do an update on what's going on. Watch for the next one this coming Monday. And as we know now from experience, all it takes is a few hours for the market to change, right? And do something different. So there you go. All right, next show, Thursday, May 8th, sooner than you know, sooner than you can imagine. Here are all the topics. We're not going to get to all of these tonight because we have a lot of time on the monthly market review and U.S. policy, as you can imagine. And of course, the CB3 methodology, we're going to talk about whipsaws, and that's not something that you have out in the barn to cut timber with, okay? It's a market behavior. Welcome, guys. I see Deb from South Florida and Tom from Wisconsin, and Deb from South Dakota, Tommy, Dr. J. Guys, thanks for being here. Here we are, monthly market review. So much, guys, going on. It's hard to imagine. This is where we are in a trailing year. So the S&P, NASDAQ, and Dow pretty much going through a normal existence there. Hits a lifetime high in early January, and then retests and confirms that high in February, and then just drops like a rock from there. Simultaneously, of course, President Trump is introducing these tariffs. So it's not exactly clear whether this current pullback, it's still a pullback, it's not a bear market, because it's between 10 and 15%, although that varies like hour to hour in the last 6 days. But during this pullback, it's not really clear if it's 100% tariffs or there are other factors. I think there are other factors, but certainly the tariffs have something to do with it. We are still within Donald Trump's first 100 days. There's 18 more to go after tomorrow. And it has been more, I think, happened in this 87-day period than in 4 years with many other presidents, maybe every other president in my lifetime. And in fact, more than in the first Trump term. So lot to talk about. So the uncertainty of tariffs. This chart pretty much says it all. Every once in a while, there gets to be a little bit of an increase on the economic uncertainty index because of tariffs. You can see a little blip there in 93, and then again in 2020 because of COVID, and then a rocket ship this year, and we all know why. So here is why these past, it's really 6 trading days because I need to include today, have been dizzying. Minus 4.8, we're going to call that 5. Last Friday, that was last Thursday, last Friday, minus 6%. We're going to call that 6. Monday looks like it was deceptively simple and not very dramatic, but low to high, it was an 8% move in the S&P 500, followed by Tuesday, which only closed down 1.57%, but again, a 5 to 6% move intraday. And then yesterday, 9.5% up. Or almost 10% of the total value of the S&P 500, and then today giving half of that back when the range is 2.38. I mean, it's just crazy. It's absolutely insane. You can make annual returns daily, but you can also lose annual returns daily. In my 38 years of trading, only the 2008-2009 crash eclipses these last 6 days of market behavior, but by far, this has been the most volatile single time period, these 6 days, even exceeding the financial crisis of 2008-2009. Welcome, Kay. Glad to have you. And Gene, both of you. So the greatest rug pulls. You guys know what the phrase rug pulled out from under you? Certainly that has been predominant in these last 6 days. Not so much yesterday, although if you were short, the rug was pulled out. But all the other days, it's mostly been down. So look at these dates here. 2025, that's just 2 days ago. The gain at the market open, the loss at the close, I mean, that's a pretty enormous range, but on the up and the downside, you got to go back to 87, 2020, 2008 to see ranges that were bigger. Now, 2008, I did say, was more volatile than this, but it was spread over multiple days and months. Okay, that was when Lehman Brothers crashed, Bear Stearns crashed, went out of business. All this is happening in 6 days. That's what's really astounding about it. And Jim Cramer, here you go. S&P posts worst 4-day losing streak since 2008. We just talked about 2008. Markets that open up big after days of decline almost never hold up. Well, that was pretty much true, wasn't it, Jim? And then, of course, Apple posted its 4th straight day of declines. And I love this look on his face that I managed to grab. 354 of the S&P 500 stocks, this is Tuesday we're talking about, are down 10% or more in the last 4 days. All the NASDAQ 100 stocks down as of Tuesday. And then, just 1 day later, holy cow, stocks post one of the best days on records. All NASDAQ 100 stocks close higher. NVIDIA closes up 19%. United, Delta, American, after thinking nobody's going to fly, close up 22%. Tesla surges 22%. And then just 1 day later, well, you get the picture. I'm not going to belabor this, but what I'm trying to tell you is that this particular time as an investor, folks, it's not the new normal. It is an outlier. It is an outlier. Again, 38 years I've been doing this. I've had several outliers. I can pretty much count them on one hand. Okay, I don't need to go through them, but you'll see those years mentioned later on in the show. But this is definitely one of those outliers. We will return to sanity. I am certain of that. One benefit has been that it's reduced what you're paying for a stock. So the forward PE ratio, you see that blue bar at the edge of the screen? That's dropping down to the 75th percentile. Now, that didn't reflect yesterday or today or the day before. Actually, it was just last week. So that bar is pretty much getting back to a normal range, and that's good. We want to chase out the weak stocks. I'm going to go back and forth between slides and on camera because I really want to try to personally communicate with you tonight. Folks, we're going to be fine. We're going to be fine. Almost all of you were with me during COVID. Almost everybody on this call, or at least most of you, were with me in 2008, 2009. Those folks out in South Dakota, I bet you remember that with me, and we made it through just fine. That was so much worse than this. So much worse. This is behaving more like COVID, where you had an extraneous event happen. That was a healthcare scare. This is a tariff scare, all right? And it's going to get normalized. So what this means is we've had dramatic returns. Year to date in the European defense stocks, up 38%, but month to date, down 14%. You don't have to go through each one of these. Copper, gold, the FTSE 100. We've got positive numbers on the left, and then that's year to date. And then month to date, look at all the negatives on the right, especially down near the bottom of the screen, the Mag 7. Okay, minus 12 on the year with half of it just this month. Tesla down 32%. And of course, some of that is politically motivated, but I digress. So there you go. You guys know this chart. Now I want you to lean in on your monitors. However you're looking at your show tonight, see that blue arrow to the upper right. Now, I mean, really just move in and look at that tiny little black line coming down. That is the current pullback. Now, I know this is going back 100 years, but that's just showing you in the grand scheme of market behavior how insignificant this is. I do understand you have money in the market and it's not insignificant to you. But what I'm trying to give you is that the proclivity of the market is to trade up. And if the volatility stays with us, we're going to see that little teeny black line. Let me show it to you again, get a little bit longer, but it's not going to come out and wipe out that whole area there. It's just not going to do it. All right. All right, so earnings. This is the end of our little section here, our segment here on the opening and what's causing all of this. Financials, good report. 100% of stocks reporting so far, 60% of consumer discretionary, but the average is 58%. Remember, we want to see that number around 73. Last month was 76. We've seen some 79s to 80s in a real good economic time. So I think there's sufficient data, even with only 19 reporting. And of course, for the May show, I'll know a lot more. In the June show, will pretty much, be all of reporting the first quarter earnings. But I think it's pretty obvious that we're not going to have a great quarter here. And that's okay. We have to have a negative quarter. You cannot have a recession unless you have two consecutive negative GDP quarters. All right. You just can't. And you can't have a recession when employment is still relatively strong, even though it's not gangbusters. It's great. All right. We'll get to the employment section in a little bit. So performance, CG year to date, doing pretty well, beating the S&P. So CG, you have to look down there carefully. That's the blue line. The green line is the S&P. Way down there at the bottom. So we're beating that by about 380 basis points. I do have to confess, though, in red over there, I always talk about not risking more than 1%. Now, whenever I tell you that, there's nothing that I can do to prevent a monster gap open. So if I have the stop level here and the market opens down here, that stop is going to be filled. The market participants are not obligated to fill. Oh, you wanted that filled at 57? Well, the market opened at 52. We're not going to come up here and fill you at 57. You're going to have to get filled here. And that's what happened in the DAX. It's only 13/100ths of a percent, but still kind of broke my perfect record there and makes me mad. XPEV actually traded up today stronger. CG finished higher today, incredibly. So it's not quite a 1% loss, and I think it's going to recover. But at any rate, we're liking where that is. And of course, GI doing quite well. Look at the minus 7.41 there. You know, you can see the blue line, the green line. It's like 800 basis points, guys. Here's the thing, and I'm going to say this several times during the show, and I've said this on and off for you guys that have heard my live speeches for 30 years. This is a relative performance business. In other words, if the market goes down 20, you will never see your performance be up 10. All right, we are in the market. We are trying to do better than the market when the market's going up. We try to lose less when the market's going down. Go back and watch my January show, watch that exact segment, and you will see that it doesn't happen every year or every month or every week or every day. And I'm going to get to that every day in just a second here. I had people calling me out yesterday saying, anyway, I'll get to that. It's just been an interesting week, and I'm trying to have a little levity here. So, all right, minus 7. Let's go forward here. So DS, wow, DS taking it on the chin, but I'm going to just fast forward to here. That's the lifetime performance up 256%. And you might say, well, yeah, but look, it was up 370. Yes, it was. And if you go back to January, DS was beating the S&P 500 and set a new lifetime high, up 370% for 7.5 years of performance. But as you can also see from the chart, when things go down, they get really ugly. Really ugly. So I'm actually going to take a customer question here while I'm on DS. So as you know, and I'll do this on camera. So you know that we take stops on our stocks, right? And that's in CG and GI. We don't do that in DS. So DS yesterday, market up 9.1%, right? People in their DS accounts, you know, I had one person call and say, is this right? Yeah, you're up 11.7%. You regained half the losses of the year in 6 hours. This program's crazy, all right? So how do I make the decisions for DS? Many of you have a DS account, and it's a small portion of your net worth. I tell everyone my rule is 12% of your net worth. That's it. I won't let you do any more for exactly this market environment. Okay. Question from our viewer is, with DS being buy and hold, when do you sell and purchase items? And how do you know other opportunities arise? And how do you take advantage of selling stocks and getting into others? So the answer is this. We are always 100% invested. When something starts to stink, I'm always working with a bullpen. And if I see something that looks better, I swap it out. I don't wait for what would normally be a stop level in CG or GI. I'm always fine tuning. And I can afford to have a lot of rotation in there because, again, I'm going to get, and it's no other way to say it, lucky with a really big winner. And we can go back and look at the chart here and you can see 47% winner in Microsoft, 36% in Amazon, Apple. If that were to go down, you'd see winners in the 22% in some of these AI stocks. So that is how DS works, and it's worked so far, and we're going to keep it there. The strategies are all diversified. We'll get to that more in the end. U.S. policy, obviously this is what's on everyone's mind. Nobody likes politics. At least nobody that I know likes politics. Okay. Hey, John, I just saw you and Studio Biz, and that looks like out there in Chicago, our Studio Biz friends, Tom. But politics leads to policy, guys, and you're seeing it happen at a breakneck pace here, and that has portfolio impact. And portfolio impact is followed by personal impact. All right. That's how it works. And there he is, the most powerful man in the world that can literally, with a sentence and a swipe of a pen and a declaration of a tariff, change the markets more than any other human in my lifetime. Not saying I'm happy about exactly the way it's happened, but we all know that there are reasons behind this. We have been taken advantage of, and you guys have heard this on the news, so I'm not going to repeat it other than to say one time, we've been taken advantage of for 7 decades, since World War II, since Harry Truman. All right, and Eisenhower didn't address it, And Kennedy didn't address it, and on and on and on. So this guy has finally decided this is going to be ugly, but I'm going to do it. This is a quadruple bypass, all right? Well, without any, maybe while you're awake, really painful. But when it's done, boy, that blood's going to flow. That's his theory. He may be wrong, but that's what we're counting on. So the U.S. effective tax rate percentage has skyrocketed. It has not been higher than this since in the 1900s. Look at this chart just skyrocketing here. The highest since 1909. You'll have to go back and look at, and I'll confess to you, I didn't go back and look at the Tariff of Abominations. Let me get this right. This is going to be a long night for me, folks. The Tariff Act of 1890, the Smoot-Hawley Tariff Act. None of us was around when these were in place. So this is the most extreme tariff environment culture that any of us has ever experienced, which makes sense because it's been 16 years, right? Will it be successful? The plan is not to have long-term tariffs. Everybody should know that. The point is, especially with China, enough. It's been 7 decades. We'll tariff you 300% to where your boats are going to have to turn around. You're not even going to be able to afford to pay the docking fees. Right or wrong, that's his strategy. Okay? This is the status of negotiations now on the left-hand side. And by the way, the reason these graphics look kind of dopey is I'm literally snapping pictures on. I have in my office, I have 7 TVs going, and I'm just taking shots on the screen because I can't even wait for the online publications to come out with a graphic if I'm trying to show you something for a timely show. So obviously China's retaliated, Canada has, the EU has. It's not going to matter. All right, who's going to get hardest? Obviously the Asian countries, some African countries, interestingly enough, not much in South America. That surprised me. All right, Colombia, obviously not much in Central America, but that's who's going to be hit the most. So follow this, guys. I know there's a gazillion numbers, but all I really need you to look at is the green. Okay, this is the GDP per person. So this is ranked for every country. How much does the average person contribute to the gross domestic product of each country? It's a really handy thing to know whether your country is keeping up with world standards. So in first place, at least with current data, Monaco and Liechtenstein don't count, Luxembourg. Luxembourg's about as big as St. Lucie County for those of you in Florida, or Cook County for those of you up here. It's tiny. So it's a little easier for it to have $141,000 produced by each citizen. But look at Switzerland. Now we're right there at number 7 with 89,000, almost 90,000. But just follow your eyes down there. Look at those other countries. So you got Sweden, they're doing pretty well. Belgium, Germany, Finland. Okay, yeah, and now it's getting smaller and smaller. Cyprus, little old Cyprus. Puerto Rico, South Korea. Where am I going with this? They're still in the 30s, okay? China is 13,000. 13,873. Really? Really, guys? That's just barely ahead of Mexico. And yet you're presenting yourself as the second most powerful country on earth. Of course, they think they're the most powerful. No. No. You have bravado. And that's going to be shown in these negotiations. And this is why. China, number 1 on the graph. They are the most dependent major economy on exports, followed by Mexico, followed by Vietnam. And who was the first country to pick up the phone and say, President Trump, we need to talk to you? Actually, they said, Scott Hassan, we want to talk to you. And hey, Scott Hassan said, well, I'm just the Treasury Secretary. You probably need to talk to the president. All right. But Vietnam got right on the phone. They can't afford to not be shipping to America and their boats not, landing. But China, Mexico, they're at the top of the list. So what about the deficit or surplus? Again, China, European Union, Mexico, Vietnam, it's all the same on this chart. Look at the bottom, though. Brazil actually has a deficit with us, which means we have a surplus with them. We ship more to Brazil than they ship to us. And the same with the UK and the same to Australia. I had a really cool experience yesterday. I had a guy from Australia fly here to present a software package that's in development. It's kind of cool to be a beta tester on that. And he was flying around to New York and Minnesota and some other people that are active traders like myself. And I said, so it's pretty cool not to be tariffed beyond the 10%. He said, yeah, that's because we have a surplus with you. You're one of 4 countries. So this deficit that I'm showing you here in all this red is the problem that's built up over the last 70 to almost 80 years. And the biggest egregious entities are China and the EU. So what about cash flow, capital cash flow? The most risk there is Korea and again, China. And again, the U.S. on the far side because deficit. I mean, we can print money and we're still the reserve currency, so we have the least risk, but we're paying for other countries to build up their military to use against us. Now, when I say other countries, I mean specifically China. Europe's not going to do that. But we are financing things for other countries that they should be paying for themselves. You might say, are we getting off the point of a financial show? Folks, we're spending money and it's coming out of your pocket. And what I believe this administration is trying to do is keeping more money in your pocket so you can send it to me to invest for you. All right? That's a good thing. That's a good thing. I don't want my money going for unnecessary taxes. And in the last show, we talked about all kinds of Doge. And yeah, you're not going to see much Doge on this show because there's so much to do on the tariffs. But the point is, more money in your pocket means a better fiscally responsible America and more affluent citizens who can invest more for their future. And we will be glad to help you do that. Thank you, Uncle Sam, or the new Uncle Sam. All right. So the biggest items that are exiting from those countries and coming to us are automobiles. They're the most expensive consumer item, except for houses, but they don't ship houses on shipping cargo ships very much. Mexico, Japan, Canada, South Korea, Germany, China. All right, not too many cars from China, but lots from Mexico, Japan, Canada. I've heard a couple different newscasters. Geraldo Rivera said, I went over to Japan. I took my family there just for fun. We rented a car, a Toyota, drove the entire island. We were there for 3 weeks. Not one Chrysler, not one Ford. It's not right. It's not right. And we are subsidizing with our tax dollars, ultimately, these countries. So because of this, U.S. growth has been projected to slow down this year. That's the first red bar on the left, and 2026. Don't know if that's going to happen. It certainly is a very interesting environment right now. And then the projected increase in effective tariffs. So we're going to see this escalating. Mexico, China, Vietnam, you keep seeing the same countries. And now India is a new one. And that's because Modi feigns as a ally of the U.S. But they have been the most egregious per capita because they're larger now than China. They weren't when all this trade imbalance started. So you're going to see India having to do some big course correction if they want to keep shipping their stuff to us. All right? More money in our consumers and Americans' pockets, less in taxes. I want to walk through this. It's going to take me a few moments. I told you guys, get that popcorn off the stove now. Bring it back. Get that extra coffee poured. All right? Going to need to do it. So I got a question here. Let me pause before I do this. With stocks being cheaper to purchase now, are we buying into these opportunities to play catch up? Not anything to really catch up on, Tom, because we are beating, because we have overperformed the S&P in CG, certainly, and done it in GI. Let me go back on camera here. GI remains fully invested pretty much all the time because in that program, I can shift from stocks to bonds or bond funds. So the typical allocation for GI is 60% stocks. That's 20 stocks at 3% equals 60, and 39% in fixed income, which is 99, and 1% cash. That's almost always the allocation, except right now, I just keep dialing back as those stocks are stopped out. We're now at 33%, all right, which means we're 66% in fixed income. CG, on the other hand, did get stopped out in multiple stocks. I don't put bonds in that program. And yes, I did go in and fish today in 4 salmon, we're going to call them. If you need a definition of salmon, I'll go back to the last show, or maybe it was the February show where I talk about stocks that are swimming uphill. These are stocks that are in definite up moves that are fighting the downward trend. And it's my belief and experience that those are going to do the best when the market does turn around, because they got a head start on the ones that were beat down. That said, I don't try to catch a falling knife for an entire portfolio. It's just too dangerous to do that. And I'm going to refer now to 2 people yesterday that texted me. One person said, gosh, here the market's up 9%. I sure hope we're fully invested. And I had to reply, well, actually, no, we're not, because one day does not make a trend. All right. Another person said, how come my account's only up 1% today after they looked in and saw it? Well, because we're in a lot of cash and the market was up 9. And I explained why. And so then today, when the market at one point had lost 2/3 of the gains of yesterday, and it did recover into the close, they were really glad I didn't go in and buy. We're going to get into whipsaws and how to manage them, and for as a money manager, but how for you to understand what they are and why we make the decisions that we do on your behalf. Again, extra coffee, get the popcorn. We're going to be here, but by the end of this call, all right, the end of this show, you're going to be, as I always aim to, you're going to be educated, enlightened, edified, and I hope a little bit entertained. So what is this with China and tariffs? So Christopher Balding, I'm giving credit where credit's due, has said, Xi has sold himself domestically and internationally as the guy standing up to America. And people that want to stand up to America should get in line behind him. He wants to be the guy. All right? Another expert said, it would be catastrophic for Xi to be seen as caving into Trump in any way. And so far, that has proven true. So they're just ratcheting up their tariffs, but they're just waiting to see who cries uncle. It will not be Trump. 0% chance on that. I would almost bet my house it's not going to be Trump. Now, people are saying, well, he receded the tariffs for 90 days, and that's what made the market jump yesterday. Well, no, we still have 10% tariffs. We just don't have the 25, 35, 47 and that whole schedule that he had on the big sheet he held up, about 7 days ago at that press conference. And we have 75 countries calling to say, hey, can we get in line and get an appointment here? So what he wanted to see was effort. 0 effort from Mexico. Even worse, 0 effort from China. All right? So Trump has learned lessons from his first term. The U.S. used to bear the cost of delays when the communist regime used to draw things out. And the longer they can draw it out, the more the Americans, former presidents, would wring their hands, take 2 years to get an agreement done. And even then, Beijing didn't honor it, okay? Enough already. Enough already. This time, Trump slapped a hefty tariff up front. So Xi's having to bear the cost right now. And when those boats show up in LA and San Diego and, to some extent on the East Coast, North Carolina, Virginia, they're paying. They're paying or they don't undock. It's that simple. They don't undock. So this $300 billion trade deficit means that China's hurting and paying much more than the U.S. So here's the thing. 67, I've said this a lot of times on the show, 67, 68, 69, it's an enormous part of their economy is dependent on exports. Certainly not all of them to the U.S., but just short of 70% of their whole GDP is exports. Cheap labor, exporting stuff that's been made cheaply. All right? That's what they are happy with. In the U.S., 26 to 29% of our economy is exports. That's it. All right? And most of these Chinese goods are replaceable. American consumers can find alternatives. So the comment that this is immediately going to be a tax on everyone, no, it's not. It's only going to be a tax if you buy the stuff. Don't buy it. Buy it domestically. And I know it's way more complicated than that, especially when it comes to foodstuffs and parts for cars and et cetera, et cetera. I get that. But what this is going to do is wake up these countries. They're going to have to negotiate. And I think it's going to create a fundamental change. The Chinese economy has been increasingly reliant on exports. I just gave you that number. If they are dramatically or drastically curtailed, China's manufacturing overcapacity will build up and put enormous pressure on the domestic consumption base. Meaning Xi is going to go, hey guys, you're going to have to start buying the stuff you're making. And they're going to say, yeah, the problem is I make $3 an hour and this, coat's like $300. So I can't, take a month and a half of wages and buy this coat. But what other choice? They need to consume domestically. All right. Bottom line, Washington has more cards than Beijing. That's not my line. I'm putting it in quote because if you remember on February 28th, a memorable day, Zelensky and Trump were getting into it, and Trump just kept saying, you don't have the cards. You don't have the cards. So I thought I would grab that line and use it again. All right. China is historically unstable. Other countries are more or less so, especially the Asian countries, but the danger of a nation that is unable to continue shipping essential products to the U.S. because of ambition, war, or instability is magnified insofar as it relies on imports to drive its own economy. That's the quagmire that every single country is in except us. There is no country that I'm aware of in the world that has a lower percentage of GDP contingent on exporting. All right, that's really, really important for you guys to understand. So the world order that's been in place throughout the 20th century has eroded good. And this new era is being engineered. We're in a period where the norms of the past century are simply not relevant. That means the 20th century, not the 19th. All right, it's an infrequent and unsettling time, but throughout human history, this has been a normal abnormality. So free trade, or trade in which tariffs strengthen other countries' finances and weaken the buyer's economy, that would be us for 70-some years. Eisenhower, Republican. Why? You saw this was happening. What are you doing? Kennedy, And then, of course, everybody since then. The financial dimension may be positive or negative for a nation, but the availability of manufactured goods depends not only on the benefits to the exporting countries, but also on the geopolitical ambitions and stability of those countries. Well, it'd be great if it was just tariffs going on, but it's not. The North Atlantic Treaty Organization, aka NATO. All right, you keep hearing about these military bases, and we need to get paid to support you guys and protect you guys. I found this map, and it's current, 2025. Look at all the Navy bases and the Army bases. I think there are Air Force bases too, but definitely Army and Navy. In all these countries, all over the place. Interestingly, none in Sweden or Finland, but none of the Baltic countries either. 2 in Poland, 4 in Romania, all right, and 4 in Turkey, all right. Who's paying for this? Well, that's, of course, the problem. The NATO defense spending, Poland has always done far and beyond the most of the Eastern European nations, and then the U.S., except that we don't have a border with Russia. We're not on the same landmass. We have as quote President Trump, a big, beautiful ocean between us. So why are we the number 2 funder? Well, it's just dumb, and that's your tax dollars, folks. And those tax dollars are coming out of your pocket over the course of a year and not going into the market or to buy snow cones. Or my voice is losing it here, guys. I've been talking a lot this week. All right, so that's what the goal of this is to put more dollars back into your pocket as Americans. All right. Greece, surprisingly, because they know how weak they are, so they're putting up their part. But France, give me a break. France, second biggest economy in Western Europe, and Europe, period. Not even putting in the required 2%, and then it just gets terrible from there. Netherlands, Norway, Denmark, Germany, 1.6. . Are you serious? Yeah. 1.6. 1.6. 1.6. 1.6. 1.6. 1.6. 1.6. 1.6. 1.6. 1.6. 1.6. 1.6. 1.6. 1.6. 1.6. 1.6. 1.6. 1.6. 1.6. 1.6. 1.6. 1.6. 1.6. 1.6. 1.6. 1.6. 1.6. 1.6. 1.6. 1.6. 1.6. 1.6. 1.6. 1.6. 1.6. 1.6. 1.6. 1.6. 1.6. 1.6. 1.6. 1.6. 1.6. 1.6. 1.6. 1.6. 1.6. 1.6. 1.6. 1.6. 1.6. 1.6. 1.6. 1.6. 1.6. 1.6. 1.6. 1.6. 1.6. 1.6. 1.6. 1.6. 1.6. 1.6. 1.6. 1.6. 1.6. 1.6. 1.6. 1.6. 1.6. 1.6. 1.6 Well, finally, because of this, and because, I know he gets a bad rap, but Trump says, nah, we're not going to do this anymore. We're not just going to fund NATO and we'll withdraw from it. And then, of course, everybody totally freaks out, knowing that Putin pretty much wants to just come in and reconstruct the Soviet Union and move as far west as he can. And that would include Germany and France and Belgium, in my opinion. All right. I think it's unlikely because the U.S. would step in at that point. But the U.S. is trying to encourage these countries to provide for themselves. The financial implication for us is more money stays here and more tax money stays in your home instead of being written to the IRS. So Europe has sharply increased their defense spending. I showed you there on the chart. Some countries, it's getting better. European defense budgets rose by 11.7%. A decade ago, only 3 NATO members 10 years ago met the 2%. And it's not much more than that now. By the end of 2024, 23 of 32 members had reached the target, including Germany, by 23, raising it to 23%. It has to continue to get better, folks. It just has to. But imagine this is it's being handled right now. The NATO thing, big deal, right? Really big deal. The whole tariff thing, really big deal. The border, really big deal. We just got signed today, the first House bill passed 216 to 214. Actually, one Democrat joined with the Republicans. There's a lot going on, and all of it affects us financially. I'm going to pause for a minute because I think my voice is giving out here. So, all right. I need to pull back my volume just a little bit here. I think I'm getting too excited. And I don't want to distort it. I looked at the history on my VU meter, and I have a couple people listening for me. So let me move the input here. All right. Any questions you want to put in the chat while I'm getting my voice set here? All right. There he is. He's not a happy guy. He and Trump don't get along very well. So where are we looking at with the Fed? So they held. They cut 50, 25, 25 in September, November, and December. They didn't cut in January. They didn't cut in March. And of course, President Trump at every meeting says, it's time to cut rates, time to cut rates. And Powell comes back and says, no. The rates that we're seeing for inflation don't warrant a rate cut. All right? They just don't. So what's it going to be going forward? So the speed of Fed easing, you can look back over history here, 84, pretty fast, 95, 89, 98. This is a length of time it took for the Fed to get back to the mean, if you will. And the dotted line is where we are right now. So it is slow. It is not moving as fast as these previous 4 times in history. And you can see it leveling out there. I just mentioned that to you in January and March. They didn't lower it. Many people think they will lower in May and possibly again in June. Don't know that. So their financial stress indices, all right? So the Kansas City Fed, St. Louis Fed, they look in the Midwest because that's more, I think, of a fair barometer, whereas prices can tend to move more violently on either of the coasts. So the San Francisco, Philadelphia, New York, Boston Fed wouldn't be weighed as heavily. I don't know if that's a good idea, but that's what they do. So other than the spike in 2020 and the spike in 08, 09, Fed's not really perceiving much financial stress. That's really all you need to see when you look at the chart here, is that it continues to be relatively low. And again, if you're going to have a serious recession, these numbers have to move higher, and they're not because the Fed doesn't perceive it. All right, and Fed funds rate on target to drop in 2026 to about 3.5. We'll not know if that's going to be the case until we get there, of course, but that's what we're seeing right now. The Fed right now is definitely in the shadow of what's going on with tariffs, for sure. So inflation, U.S. policy rates and inflation. So the Fed funds rate is in orange here. CPI, Consumer Price Index, is in blue. sometimes the Fed is late to react. So I want you to just see here graphically, we're in a recession here between 22, whatever. It was a short-lived recession, but you see the blue line go up, and the Fed just waits and waits and waits to respond. Whereas in 05, it responded quickly, and 15, it responded quickly. This is where the biggest criticism of Jay Powell comes in, all right, is that the blue line is up there. Clearly, inflation's rising. The Fed's just kind of ho-humming along without raising rates. You can see it flat, and then all of a sudden they raise 75 basis points, like 8 meetings in a row. That is not good fiscal policy, Mr. Powell. I'm sure you know that now. I can't imagine you'd ever own it, but that is the reality of it. It was slow to respond. They don't want to do that again to the downside. All right. So University of Michigan. So this is actual, let's go back here. This is actual data, the policy rates and inflation. This is the consumer sentiment on inflation. University of Michigan has a great survey where they go out and talk to like 2,000, 3,000 consumers every month and present this data, a lot of different data, consumer sentiment, but this is actually their inflation expectation. It can be wrong. Look at that 1-year expectation. Consumers think, oh, inflation's going to 5.5. And no, it didn't. It didn't. See the blue line? But now they're moving in sync. Okay. So could this be a self-fulfilling prophecy? It could. You've got the unexpectedness of the Trump administration where literally anything can happen at any time. I joked about this on the last show. I'm going to joke about it again. When I said a major deal in the January show that I did is that Xi Jinping has been invited to the inauguration. He's going to sit next to Trump. It didn't happen. He did send a representative, but that was really, really big news. That is so paled now compared to what's happening. And even Greenland, anybody even thinking about Greenland now? No. Is it still there? Yes. There's so much in the air. Think of the person that throws the bottles up at the carnival or whatever, and they're juggling all these, different whatever they are, bowling pins in the air, and then they take a glass of wine and have a sip, and they're still. That's what we're going through. All right, not an easy environment to manage money. So. Employment scenario. This is the reason we do the show here on the second Thursday is because the first Friday is when we actually get the employment report, and it was good. Now, arguably, Trump and Biden share this one, all right? And that's actually, I think, pretty fair of me to say because the survey was for 140, the actual number 228. I am certain that Donald Trump and his press secretary took credit for 100% the Trump administration. I don't know. Some of that's going to be some holiday information, holiday data that passed through here into the April report, which of course is reporting on March. But nonetheless, where did we see the growth? Over on the right-hand side, healthcare, leisure and hospitality, retail, all the places you want to see it. State and local government. That's great. Let's beef up our state and local government size because the very last one on the bottom is negative. Federal government, yes, they got doged out, all right? And it's not even close to being done. But in general, the right sectors of the economy, right, partials of the economy, but sectors, healthcare, leisure, retail, those are all areas where we want to see new jobs being added and increased capacity for those industries. It's a positive. It's a real good thing. So the unemployment rate by duration, you can see this kind of stays pretty level here. Now in 1980, it rose. We had that recession there. Had another recession in 1991. Obviously 2008, you can see the spike there. Headline unemployment rate rose, and then it went crazy 2020. All right, and then immediately tamed down, and now it's moving up a little bit, but nowhere near an area of concern. You cannot have a recession when employment is stable like this. Employment has to be rising. Now, you could say, well, there's less job openings, okay? But that doesn't mean that people are getting massively laid off and people that want work can't find it. You can still find it. It just means there aren't 3.5 jobs for every breathing person that wants a job, like it was 3 years ago or even 5 years ago. It's not that way now. Could that change as AI continues to mature? Could it change with this tariff situation? And all of a sudden, it's too expensive to buy textiles from Denmark or France. And, President rings a factory in North Carolina and says, you got to step it up. We're going to help you. All right. And all of a sudden, there are more jobs happening here. That's part of the plan. Believe me, that's part of the plan. So unemployment rate and consensus forecast, pretty flat. Again, if you see those numbers going down when I show you this again, we're heading to a recession unless it gets corrected. It's really hard to have a recession when people are employed and making widgets and things are doing well. It just is. All right. Speaking of which, let's define it. I always give you data here. I'm going to give you a narrative. I gave you a narrative on China because I wanted to walk that through with you so you understand it. When you understand something, I hope you're educated and edified, but you're also given a sense of security that we're going to be fine here, guys. When you understand, we fear what we don't understand. So what is a recession? Well, first of all, the depth of a recession is a significant contraction in economic activity, such as a 1.5 decline in real gross national income or a sharp drop in employment. Editor's note, neither of those is anywhere close to happening today. After a month of these tariffs, if the countries don't negotiate, I'll come back and tell you in May if we're closer, but not now. Duration, a persistent downturn lasting at least 2 quarters. That would be 6 months. Diffusion, widespread impact across industries and sectors. Okay, I'm just going to name a crazy example. Let's say that they do lay off 1 million people in Washington. That means the real estate market in Northern Virginia will be in a depression, not a recession, a depression. If that is the case, does that affect real estate in Atlanta or Dallas or Phoenix or Seattle or Boise? It does not. So to have a recession, it has to transcend multiple locations in America. So GDP decline, 2 consecutive quarters of negative GDP are often used as a rule of thumb, not officially required by the National Bureau of Economic Research, but that's what we use here. All right. Increased unemployment rates and reduced payrolls, not happening. Declines in retail sales and personal income. We are seeing that. And you're going to see that in the next few charts here in the next segment on economic indicators, but that's in the future. Everything that I'm showing you right now is what's affected the markets this year. As you know, when we get to the economic indicators, it talks about what could affect the market over the next 6 to 9 months. All right. Industrial production, sharp decreases in manufacturing output. That is not happening. U.S. employment during and after a recession. Obviously, you can see here in 2020 the massive spike down, the green there, and yet it recovered fairly reasonably. Other different recessions recovered 10 months, 20 months, okay? Back to 2007, which led into 2008 and 9. Of course, you remember that downturn. 74 months to recover. I do not see any scenario where that could possibly happen here. I just don't. Because there are too many things. Just go back to my Feb show, all right? Go back to my Feb show and even the March show where I talk about the number of companies that are coming in and pledging $300 billion, $500 billion, $700 billion building factories here because they front ran, word of the day number 2, all of this tariff stuff's going. We don't want to pay tariffs, so we're going to build a factory. You're not going to have to get our product off a dock somewhere in LA or Virginia Beach. It's going to be right here and we can drive it to you. All right. That was smart on their part, in my opinion. All right. I got to get another sip of water here. I'm wearing down voice-wise, guys. Questions, type them in. Remember, there's about a 15, 18 second delay. John, I just now saw your question. As of, let me see here. Get in front of me here. So CG holding 15 stocks right now. And I've just, I let them get stopped. Some I replaced, but mostly I didn't. I just let the downturn happen. I did go back in and do a little bottom fishing today. So we're at 19 out of 33 stocks right now, John, to answer your question. So 19 out of 33, which means obviously if we have an enormous up move, like we did on Wednesday, I will miss out on that day. But it's really important. You guys got to hang till the end here, because whipsaws, you're going to know and understand them better than you ever had, and why we do what we do. Okay? It's all about preservation of capital. If you guys were all 30 on the line here, you'd all be in DS and not have any stops, because you will then have 50 years. You're going to be retiring at 80. Those of you that are 20, yeah, forget it if you think you're getting Social Security at 67. Not a chance, all right? But I digress. So let's get back to economic indicators, all right? And I'm seeing that I'm clipping again. I'm sorry I'm speaking so loudly here. Let me move my mic just a little bit here. All right. So again, remember, these are indicators that I'm looking at over the next 6 to 9 months and seeing how they move. So consumer confidence. If we don't have consumer confidence, they don't spend. Consumer confidence dropping, present situation dropping. Hey, Andre from New York. Expectations dropping, inflation and expectations rising. Okay, that's 4 out of 4 bad. All right. Wage growth tracker. This is an interesting chart, guys. Job hopping no longer pays off. Why? Because the wage growth gap between job switchers and stayers, I don't know if I'd use those words, has turned negative. That means you make more money staying in a job and getting a raise than you make switching a job. Look at the chart again and you'll see that it only just switched there in the last month. So staying where you are, this implies that just job hopping is not as profitable as it was. U.S. consumer spending posts the first drop in almost 2 years. Not a big deal. You can still see the overall trajectory is up, but look at those purple arrow down and even the little blue arrow down for non-durable and durable goods. So durable goods are the people buying refrigerators and cars and I don't know, septic tanks, whatever else, right? And then non-durable goods are disposables, right? So they both took a little bit of a dip there. U.S. consumer borrowing unexpectedly declines. All right, so there's the revolving credit. You see that drop, and then real revolving credit, which is implied by the CPI. So obviously you're paying a certain amount of cash to finance these cards, but that gets deducted from the inflation rate because you're benefiting there because inflation is going up, but you're paying a fixed set of interest usually on your credit card. So these are both signs that things are softening a little bit with the consumer. It's not recession worthy at all, but it could be if the trajectory continues this way. Businesses are experiencing heightened uncertainty as reflected in the Fed's Phage Book. The only bar you need to look at on this line, all right, is the red one. It's just businesses getting a little uncertain. And why do you think it is? Well, the answer is tariffs. What does it mean for me? Either as an exporter or as an importer or both, okay? If you have employees only in the U.S., you make your product in the U.S., you sell only in the U.S., you don't care. But international and even mid-sized companies are definitely concerned, and that's why that uncertainty is showing up there. Small business optimism declines the most in 3 years. Not a surprise, all for the same reasons. Again, is it enough to be super concerned? It is not, but I am seeing it. Okay. Home equity values. Now, this would be good, right? We're increasing our equity. It's increased nearly 80% since 2020. That's great. But right now, we have more in home equity assets than financial assets, and that is not a particularly great thing. Now, think about that for a minute. So, home equity is cash that's sitting there and not being spent. Financial assets can grow, and they're usually going to grow at a greater rate than your home equity appreciation is. I would say that's almost always certainly, unless you were in Nashville or Phoenix 5 years ago. So that's an area that we have to watch. We would like to see financial assets keeping up with home equity. Here's the good news. U.S. construction spending beats expectations. That's good. We want to see U.S. construction, especially on single-family homes, increase. All right. Questions on anything? I'm getting another sip of water here. Anybody? All right, I think I've answered all the questions here. I don't know if I said hi to Keith. Keith, hey, how's it going? From Bartlett. Okay, so trend following. Again, this goes back to our methodology. I've shown you in this methodology segment, I've shown you how we buy stocks. I've shown you our stop loss method. You can go back to probably October and November. Don't think I did it in December, January, and then we'll talk about how we purchase stocks. All right, that's in there. Talked a little bit about that and how we purchase stocks for DS. It's a different methodology for GI and CG. I've covered that in previous episodes. Thank you to the listener who asked me to explain about DS. What we're going to do now is explain trend following and why we don't just buy and hold, or as some people would say, buy and hope. All right. And it's for exactly the reason that you just saw what happened in DS here. Imagine if you had everything in DS and you saw you're down 22% for the year. All right. But you made back half of it in 6 hours. Then you're elated. But now today you're down 6% again. Most people would really have a tough time with that. All right. So that's an asset allocation issue. DS has a place in most, but not all, people's portfolios for a small amount, because on those days when the other two programs, because of their trend following, whipsaw preventing strategies, may underperform the S&P, DS is almost always going to beat it. It's almost always going to beat it because there are no stops. And it's invested with nitroglycerin across the investment spectrum there. Only AI stocks and Mag 7. So I got to get to the next scene here. I'm not sure what is going on. Here we go. So trend following, the epitome of no pain, no gain. Let's walk through this. Trend following works in the sense that as one has been historically been able to capture a vast majority of the upside in a stock market while simultaneously minimizing the threat of a monster drawdown. We're going to look at a monster drawdown in just a minute. Trend following is fraught with behavior challenges. Behavioral challenges means it's psychologically difficult. I can tell you this, these last 6 days, I might seem all upbeat right now. Probably because I've made it this far, but these last 6 days, do I still have hair? Yeah, it looks a lot less than I had last month. It's brutal. It's brutal because I know it's your financial future and your net worth that's on the line and your retirement dreams and everything. I get that. And so we are trying to maximize the returns that are risk-adjusted maximum returns. You got to have that risk-adjusted, and part of that risk adjustment is the usage of trend following. So trend following is fraught with behavioral challenges, especially for non-professionals. That would be you. The strategy can deviate wildly from buy and hold benchmarks. Thus, the so-called whipsaws are commonplace, really commonplace. And I've shown you this before when you see the number of trades we lose. We lose more trades than we win, but that's okay. The winners are bigger. So the average loss saved is substantially larger than the whipsaw cost. What does that mean? Let me get to the graphics on the next page here. This helps explain why trend following equity strategies look relatively good compared to buy and hold. They certainly look less dramatic. All right, I've shown this in previous CB3 episodes. Go back to probably October, November, where I've shown the hedged portfolio and the non-hedged portfolio. You're going to see a variation of that tonight. The reason we see this result is due to the fact that the benefits of trend following, i.e. avoiding infrequent mega losses, make up for the cost of trend following. And there is a cost to trend following. All right. And those of you that emailed me yesterday or texted me and said, hey, how come we're not up 9%? Well, because you weren't fully invested in the market. Because this is what we're trying to avoid. All right. CG and GI have as their goal to dramatically reduce the portfolio carnage of 1929, 47, 73, 2001, 2008, and 2020. And you might say, well, it always comes back. Okay, How old are you? When do you need your money? If you're 20 years old, even if you were 20 years old in the Great Depression, you did just fine because you were retiring sometime in the 60s, 1960s, and you're fine. But let's look at this. And I put this on here in two different ways. If you like to look at horizontal lines, look on the right. If you like to look at vertical lines, look on the left. But the data is identical. If you have a 1% drawdown, see the -1? It takes 1% to recover. Same with 5, but then it starts to stretch mathematically. Down 10% requires an 11% gain, and then it starts to get more dramatic. -20, 25, -30 takes a 43% gain until you have a 50% loss like in 2008. We did not have, those of you that were with us, we did not have a 50% loss in 2008. We had a 38% loss, which still felt awful. But Warren Buffett was down 56%. All right. But he was willing to hang in there. Again, when you're worth, hundreds of billions of dollars, you don't really care. And his customers understand that. All right. But a 60% downturn, look at the amount of dollars it takes. I don't have a single client that would live through a 60% drawdown. Well, they might live, but I wouldn't live as their manager. All right. Therefore, we used a trend following method, which is exactly what I'm explaining today. All right. So the sad story that you just saw means you've got about a 70% chance of having a whipsaw event on each side of the trade. You're not just going to hold that trade. You're going to get out and get back in and get out and get back in. And we've talked about that in the little channels that I showed you last year. I think I did in January too. Now, the stats are even more sobering for the U.S. market. So I did research here on, I think, the G7 countries. And the chances of a whipsaw are actually greater here because there's more trading volume here and there are more short sellers here. And it's just a fact of what we have to deal with. Almost 90% of the time you can expect to experience a whipsaw. And yet we don't have 90% losing trades. We have about 68% losing trades, 32% winners, although at one point last year in CG, I was up to 38%. But that still means 62% losses, all right? Again, if your wins are 2.5 to 2 3/4, even 3 to 1, which we had for a short period of time, maybe 2 months, 3 to 1 winners over losers, you're going to be fine, all right? So if you're a trend follower, you got to expect whipsaws most of the time. So for example, you buy something at 100, put your money in cash, then rebuy it because you get stopped out at 110. It's going to cost you $10. Let me show you the graphic on this. So this guy, and he's a little bummed here. He bought something at 100. It goes up. It goes up. Here comes the little blade, and he's decided he's going to risk $5. All right. He buys it at 100. It goes to 95, and he stops out. All right. It keeps going lower, and he's thinking, wow, I was a genius. Now it's trading at 90. Well, then the green line comes in. It's like, oh, gosh, now it's back over 100. Now it's at 105. That means that my initial prognosis or projection for that stock was positive, and I got to go back in. Well, you've lost the $5 from 95 to 100, right? And you've also lost it from 100 to 105 because you're rebuying it higher. It would have been better if you just stayed in. But what if, look at the blue line, what if it had continued and gone down to 0, like Eastman Kodak, all right, or many other bankrupt companies in American history? I'm not going to risk an unlimited amount of your investment capital on that. I will put up with the whipsaws in what you just saw. Here's what we saw this last 6 trading days, and you can see his expression is considerably different. All right, and that is because I literally have not moved from my desk when the market is open. And actually, I'm sitting here at 5 watching the European markets trade, and Asia's already closed, but the futures still trade, and you can get an idea there. It's also why I'm hoarse, because I haven't slept much. This is the graphic. I want to be in the market, but I don't want you to lose money unnecessarily. And if the overall S&P is on a sell, I have to go in and nibble. I can't go all in until the actual index itself is on a buy. And we're way off the yearly highs. Now, GI can do it. It's fully invested. But remember, I changed the allocation. It's not 60% stocks, 40% bonds. It's 30, I forgot. I think it's 32% stocks, 68%, right? 67% bonds and 1% cash. But CG is where the movement's going on. And I'm looking for salmon. I found 4 really good salmon today, and they all came through. All right. They all came through at the end of the day. We'll see. I'm looking here at the futures over in Asia, and S&P down 1.6% again. So, but we have an established low from Tuesday. So what I really would like to see is this market come down and touch that low on Tuesday. The Wednesday move, the 9% up, was just an exhaustion bounce. But this is where the pedal's to the metal. If this holds, then I'll go back in and buy a little bit more in CG. That's what the strategy is there. Makes sense? So investing in stocks obviously can be hazardous to your wealth unless you have a well-defined plan like we do here at CB3 and you execute it like we do here at CB3. The long-term profile of stock market volatility is more violent than many of you realize. When you have a year like 2024, there's no pullback. I mean, we went down 5%, but that's like, by the time you got on the phone to call me, it was already down -3 or +3%. Let's say it again. It was down 2%. So we had a drop to 5 and then like a 3% David got us back. There was no considerable variation from or deviation from the up move in 2024. All right. So the easy answer is diversification by strategy, asset class, and sector is what you need, which is why we have 3 very different disparate programs in CG, GI, and DS. All have different entry, the exit strategy, the stock selection strategy. Yeah. And each of them, I mean, DS is 7.5-year track record, folks. It's pretty amazing. It really is. I'm showing this almost every show now because people say, I just want to put it in one stock. I mean, I've had a client that just, I just want to put it in Berkshire. Okay, you can do that. And it could work as long as the financial sector is doing good, doing well, I should say. But if you put all your money in consumer discretionary in 2015 and 2016, look where it is. All right. It's still up 6%, but energy's up 27%. Wouldn't you want to have a little bit in energy the next year? That's why we rotate. I mean, it's active management for a reason. You lose some of that, I'm at 6% here and consumer discretionary just because I'm loyal to it. No. You marry your wife, you marry your spouse, you date your stocks. All right. And you can see throughout the chart. And then you have 2 years back and back. Look at energy, 21 and 22 at the top there. Okay. Next year it's negative. So you just have to keep awake, guys. You just got to keep awake. So that's how it works. And let me go back to our slide here. So if you got questions, type them in. We're getting ready to wrap here. These are our segments. I will pick up crypto. Nothing much going on in crypto right now. It's kind of quiet. And the same with housing. A lot going on with AI, although nothing groundbreaking. Much more important that I covered what was happening in U.S. policy and the performance and obviously stock selection, or in this case, money management. So next show, May 8th, you guys know that. Check out the podcast. I just want to bring this up. So I had a podcast that went live on Monday. I went on CB3 Live, and I don't know if you guys click the little bell, but you really need to do that because if I just decide to go live, I may not give you any warning. I actually used my normal 20-minute waiting room video, and I had 3 people say, why do we have to sit through that? It's like, well, you've been sitting through it for 5 years. Well, I never do that. I just come right on at 1 minute before 7. Well, I do that so people can, get in line and watch it. But I guess, let us know. You're going to get that survey on Monday like we always do. Let us know what you want there. If I have an impromptu, and I would say it more likely than not that I'm going to have another impromptu here or there until we get this tariff histrionics settled down. But I may just start with a little theme music and then launch into it. But you will not get notified unless you get that little bell check. So you can, even if you're registered on the channel, go back and click the little bell. And then on the podcasts, I can go live anytime. Trying to do it once a week and then tweeting every day, of course. So in summary, as I always do, for we have not been given a spirit of fear. This is not the time to fear, folks, but a spirit of power, love, and a sound mind. Thanks, John. I appreciate your affirmation. Folks, this is an exciting time. John, I think, was the one who said, let me get the exact quote here if I can find it, weeded out. I need to get rid of the losers, folks. I'm talking to my stock now. If you can't hang in there through a little 10, 12% pullback, see ya. Don't need you. All right. But there's 14, now 19 other stocks in there that somehow braved this storm. And I want them in there because all the other portfolio managers are going to be buying them hand over fist. That's something I really shouldn't say or promise. But in the past performance is no guarantee of future performance. In the past, often the salmon do quite well during a recovery, and we want to have as many salmon as possible. All right. That's what we're doing. So thanks for watching. Thanks for being here. Thanks for being clients and viewers. I hope you were educated. I hope you were entertained. I hope you were edified. And we'll keep being here for you. So have a wonderful spring Easter season here. We'll be back in May. If there are any updates, I'll be going live, keeping you up to date. God bless you guys. I'll see you next time.